Hello my fellow investors, and welcome back to the earnings report as well as stock analysis video. And today guys, we're going to be taking a look at one earnings report and then another company's earnings report and stock analysis. For the first one, we're going to take a look at Warner Bros. Discovery, just the earnings report, and give any possible changes that I may have with the valuation of the company because, well, I kind of already covered this company like a couple days ago. So I figured, you know what, the earnings report just came out. Tony even told me about it. So I'm like, you know what, let's just cover the earnings report, go over if there's any changes that I may want to put to it for the discounted free cash flow, and if there isn't, then we keep it the same, and if there is, then we change it and then see what we get. But for this one guys, if you guys would like to see the full-blown stock analysis, I just put a video out not too long ago, so actually it was this week, and if you guys want to see that, you guys can see it there. But for now, we're only going to take a look at the earnings report for Warner Bros. So with that said, let's get started with this analysis. So we get over here the earnings summary. Now, EPS normalized estimate, unfortunately they have not updated this yet. EPS normalized estimate, negative 24 cents. EPS gap estimate, negative 45 cents. Revenue of $11.23 billion. So, you know, they were expecting this thing to come down a significant amount. So, how did it actually fare? Well, Warner Bros. Discovery GAAP EPS of negative 86 cents misses by 41 cents. Revenue of $11 billion misses by $220 million. So not so hot. Not so hot in the slightest. I mean, they were expecting negative EPS already, and they did even worse than that. So that's not good. And the revenue missed as well by a whopping $220 million. Now, coming over here into the actual earnings report, like always, guys, this will be linked in the description below for you guys to read for yourselves. We got over here, well, actually, the first thing that we got over here, it is the CEO's comment. Quote, with the major restructuring decision behind us, he's mainly talking about, by the way, if you guys do not know, they recently bought the HBO series as well as the Warner Bros. Pretty much brand from AT&T. So that's what he's pretty much talking about. And they took on, guys, a lot of debt, and they issued a ton of shares to do this. Again, I covered all of this in my stock analysis for Warner Bros. Just a couple days ago. But that's pretty much what he's talking about when he says, with the major restructuring decision. This year, we are focused on building and growing our businesses for the future, and we're off to a great start. We're seeing strong momentum across the enterprise, including our exciting long-term plans for DC Studios, the historic success for our latest HBO series, The Last of Us, and significant financial and operating gains in DTC, and the record sales of our newest game, Hogwarts Legacy. And with our unparalleled portfolio of assets and IP, a growing roster of exceptional creative talent, and some of the buzziest storytelling in the industry, we believe we have repositioned our business to take full advantage of the many opportunities ahead, said David Zaslav, President and CEO. And, you know, that's something that we definitely have to take a look at. They recently just got, as I said, the whole Warner Bros. Part, the HBO series and all that stuff. So it's going to take a little bit of time to see how this actually fares when it comes into incorporating it fully into the business. Sure, the merger has already happened. However, we still do not know the ramifications of this thing. So, you know, numbers are going to be kind of funky for I would say like a few years, honestly. Let's come over here now into the Q4 financial summary and operational highlights. We got Q4 total revenues were $11.008 billion. Revenues decreased by 9% ex-FX compared to the prior year quarter on combined basis. Net loss available to Warner Bros. Discovery was negative $2.1 billion and included $1.85 billion of pre-tax amortization from acquisition-related intangible assets and almost $1.2 billion of pre-tax restructuring expenses. Q4 total adjusted EBITDA was $2.6 billion. Adjusted EBITDA decreased 2% ex-FX compared to the prior year quarter on a combined basis. Q4 cash provided by operating activities increased by $2.85 billion, and reported free cash flow increased by $2.5 billion. Again, that sounds really surprising since they just got an entire new aspect, right? They just got an entire new source of income, an entire new source of revenue. So yeah, you know, they used up a lot to get it, but now they are getting that subsidy as well, right? They're getting that kind of subsidy when it comes to what they just invested, since this is generating a lot of free cash flow for them. Ended Q4 with $3.9 billion of cash on hand, $49.5 billion of gross debt, and 5x net leverage. Global DTC subscribers increased 1.1 million to 96.1 million at the end of Q4. By the way, I have no idea what DTC is, so if anybody could tell me, that'd be great. I'm not really into streaming services like at all, and I have no idea what DTC means, right? So yeah, sorry about that one. I do not know what that actually means. But anyways, DTC subscribers increased 1.1 million to 96.1 million at the end of Q4 versus 95 million subscribers at the end of Q3, helped in party by the relaunch of HBO Max and Amazon channels in December 2022. In Q4, TBS, TLC, and TNT were among the top 5 cable networks in prime time for adults 25 through 54. Continued strength in storytelling as highlighted by our 22 nominations and 8 wins at the 8th Golden Globes Awards and our 14 Academy Awards nominations, including Best Picture and Best Actor in the leading role, nods by Warner Bros. Pictures' Elvis. Okay, alright, at least they got a lot of stuff going for them. It's just that, because of that acquisition, they're going to be kind of iffy for a couple years, in my personal opinion. Let's actually take a look now at the revenue we got over here on the 3-month ended. In 2021, guys, actual revenue, total revenues was $3.2 billion, and in 2022, total revenues $11 billion. That was a pretty big change, honestly. Now we do see here that for the pro forma combined, it was a decrease by 9%. In 2022, it was 11.008 billion, and in the 2021, it was 12.4 billion. Again, that's a decrease of 9%. I don't really know what that is, though. The pro forma combined, I'm not really sure what that is. I'm just going to take a look at like the actual, because I don't really know what the other ones mean. So we got over here net loss income available to Warner Bros. Discovery Inc. In 2021, it wasn't even that much. It was only $38 million. And well, in 2022, it came down to negative $2.1 billion. Adjusted EBITDA, we got $1.14 billion to $2.6 billion, so that was an increase. Cash provided by operating activities, $884 million 2021 to almost $2.85 billion in 2022. Our reported free cash flow grew massively, guys, from $784 million to $2.5 billion. That's honestly what I like the most to see. I get that, they're going to be down and a lot of stuff, but cash flow is pretty much king, right? And again, they did just get a brand new form of free cash flow through the HBO services. So keep that in mind when looking at these earnings report. And now let's actually come back into the calculator. And do we want to change anything here? Honestly, not really. I still hold to the fact that we just have to wait a couple more years to see how the effect of this acquisition will actually serve. Obviously, it's going really good when it comes to a free cash flow approach, but because it was such a big acquisition, right? It was such a huge acquisition that it just changed everything within within Discovery's internals. We desperately need to wait. At least me personally, I think that we need to wait to see what are the ramifications of this. So for now, I still hold to my revenue growth assumptions of 8, 10, and 12%, and a projected share buyback of -1, 0, and 1%. Again, if you guys would like to see the full stock analysis for this, the link will be in the description below as well. Now with that said, guys, let's head over to another company that had earnings this week, and well, this one was actually this one was recommended by Tony a while ago, and I looked at it now and I'm just like, you know what, they're having earnings, may as well just wait for earnings. So let's cover that right now, and that is the company Domino's Pizza. And guys, you want to know something about Domino's Pizza? I love Domino's Pizza. Well, first of all, I don't really eat pizza because I have been on a keto diet for like several years now. I'm 27 years old, and I think I started when I was 21. So unfortunately, I can't eat pizza unless it's cauliflower pizza. But I digress. I love the company. I love the food, even though I can't eat it. And something I love more, guys, is the stock. And one of the reasons why I actually love the company is just because it's so simple. I absolutely love it. Simplicity is the name of the game when it comes to investing. It really, really is. You could have like all of these major companies, like one of the most complicated companies out there, for example, would be like the tech sector. You have all of these, different semiconductor companies that have like all these like crazy chips with like all these processors with all the. At the end of the day, you want to know something? A company that sells pizza, it's easy to understand. It's you know exactly what kind of products they make. You can only innovate the pizza so many ways up until you're out of ideas. So that's why I actually really do like companies like, for example, Dunkin' Donuts, Domino's Pizza, right? Companies like these that just have like simplicity to them. Waste management is another one. Is a really, really good way to invest, in my personal opinion. So let's actually get started with analyzing the earnings report for Domino's Pizza, as well as doing a stock analysis too. And of course, I have to give credit where credit is due. This one was brought up by Tony Myers a while ago. I don't even remember when he recommended this one, but you know, this one was brought up by him, and a bunch of other ones that we will get to probably sometime late next week. So with that said, let's get started with this analysis. So let's take a look at, guys, the Seeking Alpha's earnings summary. They do have this updated. We got over here EPS normalized actual came in at $4.43, beat by 45 cents. EPS gap actual $4.43, beat by 46 cents. Revenue $1.39 billion, which was a miss by $44.12 million. So now, guys, let's come over here into the actual earnings report. And again, just like Warner Bros, this one will be linked in the description below as well. We got over here, guys, global retail sales growth excluding foreign currencies impact 5.2% for the fourth quarter and 3.9% growth for fiscal year 2022. US same-store sales growth. Remember, guys, when it comes to retail companies, you really want to take a look at same-store sales. This is one thing you really need to pay attention to, because a company could just pretend, or at least I wouldn't say pretend, but can inflate the number of sales if they keep putting in more stores, right? But if the same store sales numbers grows, that means that they're selling more and more product in the same stores that they originally had. So that's essentially what you want. You don't want the numbers to be inflated. Nonetheless though, US same store sales growth 0.9% for the fourth quarter, 0.8% decline for fiscal year 2022. So that's kind of concerning. They grew on 0.9% for the fourth quarter. However, for the entire year, they fell 0.8%. International same-store sales, excluding foreign currencies, grew 2.6% for the fourth quarter and only grew by 0.1% in the fiscal year 2022. Global net store sale growth of 361 for the fourth quarter, or 1,032 for the fiscal 2022. Diluted EPS up 4.2% to $4.43 for the fourth quarter, down 7.5% to $12.53 compared to fiscal 2022. Wow, guys, that is a roller coaster. That is an absolute roller coaster of a freaking earnings. You can see that, like, for the fourth quarter, they pretty much just beat overall, and then for the fiscal, it's just collapsed. Like, it just went down like a significant amount. Not really good to see. Now, let's actually come over here into the CEO's comment. We got over here, quote, "We pride ourselves on being a work in progress brand, and there is no better way to describe this period in our history," said Russell Weiner, Domino's chief executive officer. "The Domino system has a lot to be proud of, while also having opportunities to address. We experienced significant pressure on our US delivery business in 2022 and focused our efforts on creating solutions. We also drove continued momentum in our US carryout business and achieved strong international store growth. Over half of our orders in the US now come through the carryout channel, and we are number one in both the delivery and carryout QSR pizza segments. Our brands and company are better positioned than ever to win in the marketplace and create meaningful value for our shareholders." You want to know something, guys? Even though they are struggling here a little bit, you know, well, how can I say this? Domino's Pizza, if you guys know about Domino's Pizza, like in the early 2000s, this thing was garbage. This thing was absolute trash. And they completely remodeled, you know, well, remodeled in the sense that, like, they remade their pizza. Like, they got a lot better ingredients and all that stuff, and they managed to get out of that. So even though they are going through a rough time right now, honestly, seeing or at least knowing their history from like the early 2000s, I think that they'll be able to make it out of this pretty unscathed, in my personal opinion. I actually want to come up here because while I was reading this, I saw these two paragraphs over here that are kind of important to read. So let's actually read them. During the fourth quarter of 2022, the company franchised 114 U.S. companies-owned stores in Arizona and Utah for $41.1 million. In connection with the 2022 store sale, the company recorded a $21.2 million pre-tax gain on the sale of related assets and liabilities, which included a 4.3 reduction in goodwill. So that's actually really interesting, the fact that they refranchised 114 stores in Arizona and Utah. I believe that I believe Phoenix, Arizona specifically, is one of the biggest growing cities in the United States. Now the second paragraph here actually has to do with their dividend, which is again really important for us dividend investors. We got here, subsequent to the end of the fourth quarter 2022, on February 21st, 2023, the company's board of directors approved a 10% increase to the quarterly dividend, and $1.21 per share quarterly dividend was declared as outstanding common stock for the shareholders of record as of March 15, 2023, to be paid on March 30th, 2023. Wow, guys, another company that just increased their dividends by 10%. First it was Home Depot, and now it's Domino's Pizza. Now, you guys remember Home Depot? That payout ratio was very close. So let's actually, well, I wasn't close at all. It was over my 60%. So I really want to take a look at the payout ratio in regards to Domino's Pizza now with this 10% increase to $1.21. But before we actually get into that, let's take a look at some of these numbers and compare them to 2021. So of course, with the net income, guys, in 2021 fourth quarter, it was 155.7 million. And then fourth quarter of 2022, 158.3 million. That was a pretty good increase. However, take a look at this. On the fiscal of 2021, it was $510.5 million. And in fiscal 2022, $452.3 million. So even though they did beat on the quarter, guess what? Or at least quarter 4 of 2021 and quarter 4 of 2022, on the year, which is the most important number, obviously, they came down a significant amount. When it comes to the diluted EPS, well, once again, we see it right here, $4.25 fourth quarter of 2021 to $4.43, obviously. And in the fiscal, $13.54 to $12.53. So as you can clearly see, guys, it was, from one year to the other, they came down a significant amount. And now something else I really want to cover, it is their guidance, because I mean, we've been seeing that guidance has been driving stock prices a lot recently, and not just like recently, I'm talking about like within like the past several months. So we got over here, as of the date of this release, the company provided the following guidance for fiscal 2023 related to the impact of changes in foreign currency and exchange rates on international franchise royalty revenues, capital expenditures, blah blah blah. Okay, so we got this over here. Impact of changes in foreign currency exchange rates on international franchises revenues. Guys, we got -$2 million to -$6 million. That's the guidance. Okay, capital expenditures, they're expecting 90 million to 100 million. General and administrative expenses, 425 million to 435 million. Market basket pricing change from 3% to 5%, an effective tax rate going from 22 to 24%. Now, what I'm really interested though, it's this part over here. We got, in addition to given our current macroeconomic headwinds that are impacting companies' U.S. delivery business, in particular, the company is updating its 2 to 3 year outlook from 6 to 10% global retail sales growth, excluding the foreign currency impact, to 4% to 8% global retail sales growth, excluding foreign currency impact and global net unit growth from 6% to 8% to 5% to 7%. The company expects results for fiscal 2023 to come in towards the low end of the range for both metrics. The company looks forward to providing more detail at an investor day that will be held before the end calendar of 2023. We get over here, guys, global retail sales growth excluding currency. Take a look at this. The previous, they were expecting 6 to 10%. Now 4 to 8. They just decreased it. Oh dear Lord. And global net unit growth, 6 to 8% was before, and now updated 5 to 7%. So they're decreasing this by a significant amount, well, by essentially 2%, right? The range, the min and max range, by 2%. So guys, with that said, let's jump into the calculator to see what we can actually find out based off of their current fundamentals. We got the ticker symbol for DPZ, market cap of almost $11 billion and a PE of 24.84. The funny part about this PE, guys, is that last time I did this, well, first of all, I had a terrible mic, and well, the PE I believe was 30, and right now it's down to 24.84, and the current share price is $307.86. In fact, look at this share price, guys. Take a look at this on the 1 year. They're down 23.44%. Year to date, 9.26%. Guys, they fell off a cliff as of today. Yeah, it was as of today they fell off a cliff because of their bad earnings. And wait until you guys see by how much they came down today. It was absolutely insane. 52-week range, guys, $299.41 to $448.99. Guys, this is a 52-week low company. This right now, Domino's Pizza is a 52-week low company. Oh dear Lord. I really do hope that the fundamentals say that this is a buy right now, because oh my god, this is looking like a great opportunity. And you want to know something else? Today, intraday, take a look at this. Down 11.65%, $40.60. Oh my god, absolute catastrophe. When it came to that earnings report, guys, they absolutely bombed it. And I mean, yeah, we even seen, you know, the guidance. They're lowering their guidance. Their fiscal from 2021 to 2022 came down a significant amount. So it's not surprising that this fell this amount. Now, they do have a dividend, which, I mean, we even read that they have a dividend. And this is the one updated for the $1.21. Now, coming over here to Seeking Alpha, this is not updated yet. However, this is a yield currently of 1.26%. And if we actually try to do the math over here, so if we do the $4.84, which is the new quarterly dividends times 4, and then we divide this by the $307, which is the current share price, guys, this is a current yield of, as we can see right here, 1.58%. So right then and there, you got an increase in yield by around like 0.25%. Not too shabby. Payout ratio is 34.3%. 5-year CAGR is a whopping 19.05% with 9 consecutive years of dividend payment. Ex-dividend date passed as of December 14th. Payout date was on the 30th of December, and they pay their dividends quarterly. However, we did read in the earnings report that they are going to have an ex-dividend date of March 15th, paying out on March 30th. And now, based off of the current shares outstanding, they pay out $171.34 million. And as of their 5-year average free cash flow, after this is paid, they're still left with $256.22 million. And as of their last year's free cash flow, it is $216.76. So unfortunately, you can see that their last year's free cash flow, it is lower, not by a lot, but it's still lower than the 5-year average. That's a little bit of a red flag. These payout ratios are 44.15% for the last year's free cash flow and 40% for the 5-year average, still significantly below my 60% threshold. So now let's come into the fundamentals, and let's go through these rather quickly. We got over here, guys, 5 years ago of $362 million to 1 year ago of $452.3 million for the net income, increase of 25%. Really nice, consistently increasing. Just as of 1 year ago is when they came down slightly, so I'm giving this a 60%. Looking now at the free cash flow, we got $274.3 million to 1 year ago of $388.1 million, increase of 41% with an average of $427.56 million. Once again, a really nice consistent increasing graph. However, the jump from 5 to 4 was a bit much, and the fall from 2 to 1 was a bit much as well, so I'm giving this a 55%, still though looking fairly decent. When it comes into the revenue, this one's absolute perfection. 5 years ago of $3.4 billion to 1 year ago of $4.5 billion, increase of 32.17%. And guys, this graph, there really isn't any outliers, there really isn't any massive jumps, massive dips, so I'm giving this a 100%. Now, this one caught me by surprise. The assets minus liabilities. Guys, Domino's has more liabilities than assets, and that caught me by a tremendous surprise. And in fact, I was looking at this multiple times because I'm like, okay, I gotta be inputting the numbers wrong. And in fact, I'm actually going to prove it to you guys right here. Looking at the total assets, we went from 907 million to 1.4 billion to 1.6 billion to 1.7 to 1.6 billion. So you just remember these numbers, okay? Now taking a look at the total liabilities, take a look at this. 3.9, 4.8, 4.8, 5.8. I'm looking at the total liabilities. I'm not lying to you guys, right there. Total liabilities. 5.8, 5.8, and 5.8. Guys, they have a ton of liabilities. Oh dear God. Like, it's just really, really bad. They had 1 year where they increased it slightly. Aside from that, it's just going down. Average total assets is only $1.6 billion. Average liabilities is $5.5 billion. Doing this difference, we get negative $4 billion. I'm giving this a 10%. Honestly, I'm going to change this down to 5 because that is just really, really bad overall. Looking now at the cash flow minus the liabilities, well, you know, their cash flow is doing fairly decent, but those liabilities aren't. And, well, this translates to this. And I gave this a 15%. I'm going to change this now to a 5 again because I just did not realize it was this bad. Average cash flow minus average total liabilities, it is negative $4.66 billion. Guys, this graph, again, they had 1 year where they went up slightly. That's about it. As of 3 years ago, it just kept coming down really hard. Looking now at the shares outstanding though, this one looks absolutely gorgeous. And this is what I believe they're mainly putting their cash flow towards. This and of course that dividend. Guys, consistent decrease year over year. And even during COVID, they did not increase. Take a look at this. 41 million shares 5 years ago to 1 year ago, actually today, of 35.4 million shares. That's a consistent decrease on the 5 year of 13.66%. And even from the previous year to the current year, almost 2%. Even during COVID, guys, they kept it the same as 4 years ago of $38.9 million. Again, the same thing as 3 years ago, $38.9 million. So I have to give this a 100%. And lastly, when it comes to the cash equivalents, they currently hold $114.8 million with an average of $114 million. Now looking at the overall grades, guys, net income 60%, free cash flow 55%, revenue 100%, asset minus liabilities 5%, cash minus liabilities 5%, shares outstanding of 100%, overall grade of 62. The biggest problem that they have is that liabilities. They need to bring those liabilities down. They need to start focusing their cash flow onto the liabilities, guys. If they would just do that, everything else would just fall into place. Unfortunately, even with that, 62% isn't even that bad. And again, you have to take a look now as to what the company does, right? Pizza, really simple. Actually, pizza is technically something that is very recession proof, because, well, I don't know. Some people say it's recession proof, some people say it's not. I don't really know where this put it, but I don't think that people will stop eating pizza. If how can I say this? Basically, if the price of eggs keeps going up the way that it is, would you buy a box of eggs, like a dozen eggs, or would you just rather get a pizza for the night or something like that, right? I don't know. Some people say that it's recession proof, some people say that it's not. So I'm gonna put my hands up on that one, saying I don't know. 62% though, with these liabilities, it's actually not that bad. Now let's come into the discounted free cash flow. And unfortunately, guys, even though that this is a 52-week low company, well, the target share prices are still a lot lower. We got over here the revenue growth of 4, 5, and 6%. I'm getting these numbers from Seeking Alpha's revenue growth tab. We can see that forward is estimated at 5%. So once again, I went 4, 5, and 6%. For the particular share buyback, in the past 5 years, they've been doing around 13%. I personally don't think that they'll be doing this in the next upcoming years. I think that, well, at least I hope that they focus their cash flow into the liabilities, not their shares outstanding. But nonetheless, I'm going to say 5, 6, and 7%. Doing this, we get the target share prices of $146.70 to $160.43. And now adding on the debt, guys, unfortunately, 2 out of these assumptions are in the negatives. Only one of them is in the positive, and the target share price is $4.14. They got a ton of liabilities. I mean, when the assets minus liabilities is consistently going down, they have a ton of liabilities. So it's unfortunate, but it is what it is. And with the current share price of $307.86, 52-week lows though, the best target share price, at least for my assumptions, it doesn't even get to $200. So take that information as you will. I mean, I don't know what this. I really did hope that this thing would be within my target share prices, but unfortunately, it is not. I think that this would be a case that I would just sell puts for this company at around this $160. Maybe really long puts. I would say, I don't know if there's volume up there though. That's the problem. Like somewhere in like November for like $160, $175. See if there's volume up there. See if one of those puts would be sold. You would make a little bit of income from that. But I do not see a lot of income being made from $160, $170 from a put that far out in Domino's Pizza. But then again, I haven't really checked the option chains. Which, by the way, I probably should be doing that. You know what? I will add that to my stock analysis from now on, because I think it is actually kind of cool. So yeah, it really does. You know what? I'm gonna do that. I'm gonna write that down. I'm gonna do that for the next, well, for the foreseeable future when it comes to stock analysis. But guys, as it currently stands, yeah, this is essentially what I'm getting. Obviously, you guys might get something different. This is why I have all of these for free. I have all of these calculators for free because I want you guys to be able to make sound financial decisions without having to pay me anything. Because at the end of the day, every investment is the present value of all future cash flow, and this is not financial advice. So please have all of these calculators for free. And the most I'm asking for, honestly, really, the most I'm asking for, guys, it's just like, subscribe, comment. It really does help out with the algorithm on YouTube. Thank you so much for the help so far. I really do appreciate it. Well, I should say, we really do appreciate it, because now it's me and Boy. Boy does technical analysis. I do fundamental analysis. And I really am glad that we have essentially 2 channels in one, right? If you guys like technical analysis, then great. You guys can watch his stuff. I don't mind it. And if you guys don't like technical analysis, then you can watch my stuff. And I do eventually plan in the future to bring in a third person for the qualitative analysis kind of aspect of investing. So be on the lookout for that. And again, the more that you guys support us, the faster I can implement more and more content on the channel for all of you guys to have. And of course, everything will be for free. So now let's actually take a look at this dividend, because we did just get an increase of 10%. However, the current share price is telling me that's way out there. So putting in $5,725, this nets us, guys, an annual dividends of $90.01. I personally don't think that this is good enough for me. However, though, Domino's Pizza does have a pretty good trend of going up. So, you know, it's a really easy company to understand, and it might serve itself as a pretty good opportunity if it were to fall, at least for me, if it were to fall down to like sub 200. Now, I actually want to do that. Let's put this at around like $170 and see what the dividend would be at that point. Well, doing that, guys, the dividend now would be $163. What a difference, right? What a difference. It really does matter what you pay for a company. So if it were to fall down to like, you know, sub 200, I would consider this a pretty decent buy from a fundamental perspective and even a dividend perspective as well. But at the current share price, to me, it's just a little bit expensive. All in all, when it comes to Domino's Pizza, as I said, guys, they are a really easy company to understand. Again, you can only reinvent the pizza so many ways until you can't anymore, right? So yeah, I mean, it is what it is. I know Domino's Pizza had a massive run, like recently, like within the past few years. Absolute monstrous run. However, based off of the fundamentals, $307 to me just isn't cutting it. But again, you guys can make that decision for yourselves. That pretty much does it for this video. Like if you like, comment, subscribe. It really does help out with the algorithm on YouTube. You guys can follow us on the new tech sites. Link in the description below. So with that said, peace out, and I'll see you all in the next stock analysis video as well as earnings report.